What successful cash flow management looks like. The difference between positive and negative cash flow is a key topic for any business owner to understand. Understanding the types of cash flows that are happening in your business will help you make better decisions about how to allocate your funds. This video discusses the differences between what each type of cash flow means, so you can be sure you're making smart financial decisions for your company. Positive and negative cash flow are two aspects of cash flow, but they are perhaps the most essential element to grasp when it comes to implementing a cash flow management plan. Cash is the lifeblood of a company, so you need to make sure you have a solid strategy in place with the tools necessary to monitor your present financial status and predict your future financial success. If you're able to maintain positive cash flow, then this demonstrates that your business is operating effectively and allows for further growth opportunities. If you are constantly generating more income funds than the expenses required to keep your company running, it's a sign of financial stability, at least in the short term. This means there will be no difficulties meeting. It's critical for some company owners to keep an eye on their company's money position at all times. The balance sheet shows how much cash the firm has at the moment, but the cash flow statement reveals whether or not it's losing money or making more money over time. The bottom of the cash flow statement displays the company's overall net gain or loss in cash. Cash flow statements. The cash flow statement documents how the operational activities recorded on the income statement link to assets, liabilities, and owner's equity shown on the balance sheet. The cash flow statement chronicles changes in expenditures and inflows of money to and from different external parties your company engages with. The net change in cash for a company is shown in the cash flow statement, which depicts the net increase or decrease in money across three primary functions: operating, investing, and financing. The bottom of the cash flow statement shows the net increases and decreases from all three activity areas taken together. Operating. It's defined as the amount of money generated by operations, or the operational section, to calculate cash outflows. Negative operational cash flow could be shown on the income statement, even if your firm generates net income. The operating section starts with net income and then makes a series of adjustments for revenue and expense items that use more or less cash than anticipated. Net cash flow is the difference between the adjustments plus net income. Investing. The cash flow from investing activities, also known as the investment part, depicts the impact of asset purchases and sales on your company's cash flow. Investing activities are so named because they document your company's purchase or disposal of long-term assets. Assets can include everything from furnishings and equipment to acquisitions of other businesses. The net increase or decrease in investing cash flow is determined by adding all of the cash additions from asset sales and reductions from purchases. Financing. This is a financial transparency tool that captures all of the company's cash flow. It documents how your firm's equity and debt financings affect cash. This implies it shows how the liabilities and owner's equity sections of the balance sheet impact your business's financial flow. Obtaining new mortgages or term loans and adding more equity to your company increases financing cash flow, while paying loan principal and distributing earnings to owners reduces financing cash flow. The net change in finance income is the sum of these inflows and outflows. It may seem a lot to handle, but in essence, businesses live and die on the availability of cash in the business. Having it is one thing, managing it is another.